Hi everyone and welcome back. Look, so many people think that financial markets are random. Well, they're not. Everyone thinks that price moves because of the news. Well, it doesn't. News comes after. It's price that comes first. Did you think that bad news creates price drops? Or that maybe good news is what makes price go up? Well, that would be simple, right? That would make sense and it would sound logical. We'd think about maybe supply and demand, buyers and sellers. If buyers exceed sellers, if sellers exceed buyers. And that's what we're told, that's what we were taught. And don't get me wrong, that definitely does exist. But that's only half the story. That's just surface level. Because if that was actually true, price wouldn't move the way that it does. It wouldn't just shoot up and spike and then all of a sudden reverse. It wouldn't break out, if you like, and then dump. Or it wouldn't crash and then reverse back up again. It wouldn't wipe people out over and over again. See, none of this is random. It's certainly not natural. It's actually very structured. And most people never really actually question it or try to understand exactly what's going on. They just assume, I got it wrong. I got chopped up. But what if you didn't? What if you're playing a game with the financial markets, with your stocks, with your trading, with your gold, with your Bitcoin, where the rules aren't maybe what you think? Because price does not move on opinion. It does not move on headlines. It moves for one very simple reason. And that reason is liquidity. What's liquidity? Liquidity, where is the money? Where is the money sitting? Where are the stop losses? Where are people under pressure? Where are the forced sellers? Where are the liquidations? And that's what price itself is actually looking for. Because big money, the big investors, they can't just enter the market any given time. They need volume. They need someone on the other side. If they're buying, they need a seller. If they're selling, they need a buyer. And that is what liquidity is. So price moves to find that liquidity. It isn't random. It actually is done very much precisely, almost like it knows. See, it's not what you think. Big players, they really cannot just wander in and buy huge amounts of anything. If they do that, well, the price is going to spike against them. It's going to move against them. So they need liquidity first as a priority. So what do they actually do? What they do is they move the price away from value. They push the price to the downside if they need to. They can create fear. And when they can create fear, that forces selling, and that then can trigger stop losses. Now, suddenly, there's volume. Now, suddenly, there's liquidity. And that is when they will act. That's when they will buy. They won't buy at the top. They won't sell at the bottom. They'll buy at the panic. And it works. It works both ways. Upside and downside. They push price higher, they create excitement and, glee in the market, and that triggers breakouts. It pulls in the buyers. The buyers go, oh, look, the price is going up. And then they sell into that. That's why you see what's known as fake outs or fake breakouts, or sharp reversals, wicks on the charts that make no sense. They just don't make any sense. How does that happen? Well, again, none of this is random, it's positioning. It's the big players positioning themselves looking for liquidity. See, we're retail, everyday people that are trying to trade. You buy when the price breaks out because obviously it looks strong. It looks like it's going to keep going up. And when you see the price start to drop, well, we sell. Because in our mind, well, it feels weak. Everyone's selling, the price is going down, sell. So you react to what you see. But by the time you see it, the move has already been made. The move is already done. You weren't early. You are late. And by being late, you are the liquidity. You're the reason that the move actually happened in the first place. Because, like I said, someone needs to take the other side. And that someone, unfortunately, is usually you. That breakout that you may have bought, where you saw the price rocket to the upside, was actually their exit. That panic that you sold out of was actually their entry. And it happens over and over again, day in and day out. And it has nothing to do with us being dumb. It's just because we were actually taught to see it the wrong way. Because I guess if we all knew, well, the whole system wouldn't work properly. It's the story that we're told. Have you ever noticed how perfectly news seems to line up? Always the big news at the top. And then, when's the panic news? The panic news is always at the bottom. Markets crash because of fear. And markets rally and they move up because of optimism. But just look a little bit closer. Price itself moved first. Then came our explanation. Because news doesn't drive the actual move itself. All it does is actually justifies it. It gives us a reason to actually act. To buy when it's high, to sell when it's low. And look, that keeps the cycle going. And it sounds perfectly logical, which is exactly why it works. Because if there was no story, you might stop and question it. But instead, you feel informed. You feel like you know what's going on. When really, all you're doing is reacting. This isn't any kind of glitch. It's not any kind of conspiracy. It's certainly not corruption. I think a lot of people think that it is. Not in the way that we think. But this is the system. This is how this system works. Especially, in particular, the financial system. It's the market makers that need liquidity. It's the institutions that need the volume. And trades need a counterparty. Someone has to lose. It's just the way that the market works. And when someone else loses, obviously someone else wins. But unfortunately, that someone that loses is usually the retail buyer. That's us. Not because you're specifically targeted, as much as it can feel like that sometimes, but because we're predictable. We react to price. We follow the narrative. We chase the move. And that's the system just operating. It runs on that. It needs emotion. And we are all very emotional when it comes to money. We have fear, we have greed, we have panic, fear of missing out, FOMO. That's the fuel that powers it. So markets, financial markets, are most certainly not random. And no, I'd agree that they're very much not fair. They're very structured. They're engineered. And when you begin to actually learn about how it works, and when you see that, well, you can make that decision to stop playing the game from the wrong side. If you still think that this is random, well, you're not trading the market. You are simply the liquidity. You're the one who will be paying for it. Thanks very much for watching, guys. If you found this video useful, don't forget to like and subscribe. Put a comment down below. Let me know what your thoughts are. I look forward to seeing you in the next video.